Since Elon Musk took over Twitter and became the de facto CEO, he has been getting more and more political with his tweets. And there's a lot of concerns out there that Elon is destroying Tesla. And so what I'm talking about in this video is whether or not I think Elon Musk is destroying Tesla, whether or not I think he's going to continue being CEO of the company, what I think will happen if he isn't the CEO anymore, and then my thoughts and a price update on where I think the stock could go in the future in a recessionary environment, an inflationary environment, and with all of these negatives that are on the table right now. I like to be very clear and transparent with my portfolio and the positions I have, especially when I'm talking about stocks. So right now I have a $117,180 portfolio. We're basically flat today, right? The Fed just came out with a 0.50% interest rate hike, right? And then overall, we're down $15,800 starting February 15th, 2022. I do in fact own Tesla stock. I have a $6,546 position. I have 41.75 shares, an average share price of $257 a share. And right now the stock is at $156. So I'm down big time on my Tesla position. And so me as an investor, I'm thinking through Tesla. I'm thinking through what these implications of everything Elon Musk is doing and then Tesla in a recessionary environment. I'm thinking about all that stuff. And so I am just simply sharing my thoughts with you in this video. All right, let's talk about the Elon in the room, or the elephant in the room, right? So Elon, we're just going to scroll through his Twitter feed, right? First of all, 121 million followers on Twitter. You know, dating back, social media and organic marketing is how Tesla actually marketed in the first place and how they actually became successful in the mammoth of the company that they are. And so let's talk about the case of what happens if Elon Musk leaves Tesla as CEO. 5 to 8 years ago, if that happened, I think Tesla dies because they were basically on the brink of bankruptcy and dying as a company. And they needed Elon to do such a disruptive thing and change pretty much the entire way that the auto industry operated, at least in terms of electric vehicles and autonomous vehicles, right? That was a pretty ambitious thing. But now, if Elon Musk were to leave Tesla as CEO, first of all, I believe he would still be involved with the company, and he would probably be involved in more of a technical role, which I think is actually where he wants to be. And I could imagine a world where as long as the right person is CEO, Elon Musk would actually prefer not to be CEO of Tesla anymore. So all that to say, he's got 121 million followers, which is this mechanism of still continued free marketing for Tesla. What we see is we see the extremes. We see everybody that has that hates Elon Musk, and we see the stories of people saying that they're canceling their reservations for Teslas. They no longer want to deal with the company. And so we see all of that stuff. But what we don't see is the hundreds of thousands or millions of people that follow Elon Musk and really don't have a strong opinion one way or another. And so all in all, I would say the reach that Tesla has on social media and the reach that Elon Musk has on social media is a net beneficial aspect to Tesla. Tesla is a car company with 18.6 million followers. I bet they have more followers than every other automotive company in the world. Okay, GM, 800,000. Ford, 1.4 million. BMW, 2.4 million. So you see the point, right? Tesla has, way more followers. But back to Elon and his tweets. And my main concern is just that Elon is distracted, right? And yes, he's going to make people mad, but why does the CEO of a company that is one of the most ambitious companies in the world and could do things to really positively impact the world, why is he so focused on other things? And it's because he's, in his words, so passionate about freedom of speech and feels that Twitter is important for that. Whether you agree or not, and what side of the political spectrum you're on, that's up to you, and I'm not commenting on that. I am commenting on Elon Musk as the CEO of Tesla and whether or not I think he's hurting the brand. And where I come down is this. I do believe that over the short term, Elon Musk has hurt Tesla's brand. We saw him sell a bunch of shares to do this whole Twitter deal. That obviously wasn't good for the short-term share price of Tesla, if we just look over the last year, shares are down 51%. And even since October, shares are down, from 308 down to 156, right? And during a lot of this time, the market as a whole has actually done better. Tesla is seriously underperforming the market at this point. So first of all, over the last 10 years, Tesla's still up 6,800%, right? So still doing pretty incredible. And the reason for that is just the explosive growth. And so back in 2012, Tesla had revenue of $413 million. Fast forward to December 21st, 2021, $53.8 billion. What that is a 74% compound annual growth rate. Okay. They have grown from net income of minus $344 million to $7.6 billion. Earnings per share, this is adjusted, but negative 21 cents to $2.26 a share. Free cash flow, negative $500 million to $5 billion in 2021. Gross margins of 7% to 25% at the end of 2021. And so now we fast forwarded to what analysts expect in the future quarters, right? From a revenue basis, analysts are expecting revenue from 2022 to 2026 to grow at a 30% compound annual growth rate. They're expecting net income to grow at a 28% compound annual growth rate through that same time period. And they're expecting earnings per share to grow at a 27% compound annual growth rate and free cash flow to grow at a 43% compound annual growth rate to end 2026 at $30 billion in free cash flow. That's just incredible growth, right? And it is certainly not guaranteed to happen, but that is what analysts are currently expecting to happen. And so the thesis, if you own the stock right now, is over the short term, Elon Musk is a risk. Over the short term, a recessionary environment is a risk. The question is whether or not the stock is discounted to a point where all of that negativity is baked into the stock price. I'll talk about what I think like a buying price could be or where shares could go. I'm just going to put these estimates into a little model that gives us like a three price, a low, medium, and high price. But then over the long term, the argument is that Tesla is a dominant electric vehicle maker. Already they've expanded to different segments. And so we can see, they've got their automotive revenues, which was $51 billion and $13.7 billion in gross profit in 2021. But they've also gotten up to $2.7 billion in energy in energy storage segment, which is still growing very fast, right? And then we're talking about growing into semis, growing into the Cybertruck, growing into the humanoid robot. There's a potential for full self-driving to become a subscription service, which is very high gross margin, something that no other auto company can even comprehend or begin to try to do. And so that's the bull case, right? But what we need to do is we need to get an idea of like where the stock price could go. And again, this is going to be wrong, but I'm going to use these analyst estimates to build this little model on everything money, right? They've got this stock analyzer tool. So we're going to build a low, a medium, and a high scenario based on revenue growth, profit margin, free cash flow margin, and a potential price to earnings ratio out to 5 years from now. So we can see where they have grown revenue. They've grown revenue at 60% over the last year and 52% per year over the last 10 years. But moving forward, again, we're going to use this 30% annual growth rate, right? And we're going to put that in over the next 5 years. Okay, so I filled the rest of this out using analyst expectations. The analyst expectations are basically on the right end in the high scenario here for 30% revenue growth, 13% profit margin, 25% free cash flow margin. And then I've actually gone more conservative with the low and the medium scenario to try to be a little bit more conservative with this estimate, right? Price to earnings ratio of 22. If they're growing revenue at 30%, profit margin is 13% and still growing earnings as strong as they would be if things work out in this high scenario, then I think it deserves a premium price to earnings multiple to the market. But this is the part that's most subjective about all of this, right? Is what price to earnings ratio or price free cash flow ratio you think a stock deserves. So we've got 22 PE and a 21 price free cash flow, and we can see the current PE is showing us 40. And then in the low scenario, we've gone all the way down to 16 and 17. Our desired annual return is 10% in the low scenario. And as we ratchet our expectations up, our growth expectations, we need to want a higher return because theoretically we're taking on a little bit more risk there with that higher assumption. And again, we could just own an S&P 500 index and get somewhere between 7 and 10% a year. So we want to beat that if we're going to own individual stocks, right? This is all just a guess, but it's going to give us a price range. And so if we believe these scenarios to be true, then today the current stock price is $156.90 per share. If we believe the high scenario to be true from a price to earnings basis, we would be willing to pay $152. So in all of those cases, it is showing that the stock is currently overvalued and potentially way overvalued if you believe the low scenario to be true. Discounted cash flow, if you're looking at price to free cash flow, then everything we've put in, you would actually be looking at, in the high scenario, you would pay up to $281 a share right now. Mid, you'd pay $224, and then low, you would pay $141. Okay, this is stratosphere.io. There is a link down in the description. This is one of my favorite new platforms to research stocks. You know me, I use a lot of different platforms if you've watched these videos, but it's got one of the coolest ways to see consensus estimates and consensus forecasts, right? So price targets. The lowest forecast on Tesla is 126.67. That's right now, 21% downside. The middle forecast, or the consensus forecast, it's kind of the average, right? 315, which is 96% upside. And this is over the next year. I think that's way too ambitious, but hey, I'm a shareholder. I would love for that to happen. The Tesla high forecast is 526, 227% upside over the next year. I think that is completely unrealistic. As a shareholder, I don't expect anything like that to happen, but if it did, hey, I would be happy, right? They've also got this pretty awesome estimate forecast showing. So for the full year of 2022, 18 analysts are expecting an average of 60.52 billion in revenue. And you can see in 2021, they had revenue of 53.8 billion. So some nice growth in 2022 and 2023. Now, if they hit the high side and they're in the 80s or 82, then that CAGR is a lot stronger and more in line with kind of that 30% average overall earnings per share forecast. We can see 2022, the average is 568. In 2021, they had $1.63, so that would be a major jump. And then in 2023, 632, which comes to a compound annual growth rate of 18.46%. On the high side, you've got 682 for 2022 and 758 for 2023. Let me know in the comments what you think of my assessment with Tesla. Am I crazy for owning it? If you like this comment, you can support me for free by liking the video and subscribing to the channel so you never miss an update. Thanks everybody. Have a great day.